Hello everyone. In this video, we're going to explore the relationship between internal and external range liquidity. We'll first dive into the PDF before moving over to TradingView to look at some examples. Let's start by defining internal and external range liquidity. Internal range liquidity typically refers to a fair value gap, whereas external range liquidity is represented by a swing high or swing low, forming buy-side or sell-side liquidity. Now, combining these two, what's the connection between them? Essentially, the market only does two things. It either targets old highs or old lows, or it attempts to rebalance a fair value gap. Understanding this, how do internal and external liquidity work together? After external range liquidity is taken, the price seeks internal range liquidity. Once it reaches internal range liquidity, it will aim for an old high or low, essentially external range liquidity. For example, once the price taps into external liquidity, where might it head next? It's likely to move towards the fair value gap. Once it fills that gap, where could we expect it to go next? Back towards external range liquidity, likely in the direction of a swing high or low. You can observe how price moves in a cycle, transitioning from external range liquidity to internal range liquidity and back again. Now, let's jump into the charts to review some examples. We are on the GBPUSD daily chart for our first example. As you can see, the price didn't manage to displace below this old low or swing low right here. Now, if we expect higher prices, notice how the market runs through an old high, taking external range liquidity. After taking external range liquidity, the price then moves towards internal range liquidity, which leads to a retracement. Where can we expect the price to go next? It's likely to reach for this fair value gap, transitioning from external to internal range liquidity. Let's see how this plays out. Here, we see the price reaching into internal range liquidity. Now, if the fair value gap is respected, where could we expect the price to move? Likely towards external liquidity. And there it is, the market reaches external liquidity. After taking external liquidity, the market creates a fair value gap, which serves as internal liquidity. This suggests that we might see a retracement back into the fair value gap. Let's see what happens next, and as expected, the market retraces back to the fair value gap, respecting it. Now that the price has respected the fair value gap, we shift our focus towards external liquidity, targeting that old high. As you can see, the market takes out the external liquidity and creates a new fair value gap, which becomes internal liquidity. What can we anticipate next? A retracement back to that internal liquidity. Let's watch what happens. And here, the price fills the imbalance and respects the fair value gap, closing outside of it. Now, we expect prices to continue higher, towards that old high, which serves as our external liquidity. Eventually, the price takes out that external liquidity. In this upward move, we also notice a fair value gap along with an order block. Remember, internal liquidity isn't limited to fair value gaps. It can also be order blocks, breaker blocks, propulsion blocks, or other forms of liquidity. So, what's next? We expect the price to move lower, targeting that fair value gap and order block as our internal liquidity. Let's observe how this plays out. And as you can see, the price respects our order block, and now we anticipate higher prices towards our final external range liquidity. Finally, the price takes out that old high. Let's move to our first top-down example. Here we'll be looking at EURUSD on the 60-minute chart. As you can see, the market runs through an old high, which is external range liquidity, and creates a fair value gap that acts as internal range liquidity. We expect the price to retrace lower towards that internal range liquidity. So, let's see how this plays out. And here we go. Prices rebalance that imbalance. Now let's switch to a lower time frame and see how it develops as we look for an entry using the external and internal range liquidity concepts. We're now on the 5-minute chart, while our higher time frame is the 1 hour. You can see that the price takes out external range liquidity, and on the lower time frame, the market runs through an old high, followed by a displacement to the downside. Notice that the price doesn't respect that fair value gap, so we expect the price to move lower. It creates a new fair value gap, which we can use as internal liquidity, so we wait for the price to retrace back to that fair value gap. Finally, the price retraces back to the fair value gap, and it respects that area. Now let's switch to the 1-minute chart to execute our trade. On the 1-minute chart, the price is already in our zone, so we enter a short position. Our stop loss is just above the fair value gap, and our target is the lows from our 60-minute internal liquidity. As you can see, the market reaches our final target, and you can see how we used internal range liquidity to external range liquidity on the hourly chart for our bias. We then used the 5-minute chart to find an intermediate term high, and then used the 1-minute chart for an entry. We are now on our final example, looking at the Australian dollar versus US dollar on the weekly chart. As you can see, we have an old high that was just taken. Now if we are moving from external range liquidity, where is our internal range liquidity? Right here, we have a fair value gap. Thinking ahead, if we retrace into internal range liquidity, the price retraces back to internal liquidity. Now, if the price continues the upward trend, where is our new external range liquidity? It's right here, so we'll mark that as well. Now let's drop down to the 4-hour chart and see what happens. Here we are on the 4-hour chart. You can see the old high we took out, and I've marked our new external range liquidity, while the internal range liquidity remains on the weekly time frame. Notice the old lows on the 4-hour chart. This is what forms the fair value gap on the weekly chart. We are now in our zone and want to look for a market structure shift or a change in the state of delivery to confirm higher prices. Here, you can see the market runs through these lows and closes above them. So now, we wait for a market structure shift to the upside. And here we go. Price shows willingness to move higher by displacing to the upside and creating a fair value gap. As you can see, on the lower time frame, which is the 4-hour, we've taken out external range liquidity, and now we should focus on the fair value gap, which acts as our new internal liquidity. We wait for the price to retrace, and then we enter a long position, targeting our weekly external range liquidity. The price retraces back and respects the fair value gap, so we enter a long position with a stop just below that low, aiming for the final external liquidity, which is on the weekly chart. And here we go. The price finally runs through the external range liquidity on the weekly chart. Zooming back out to the 4-hour chart, you can see how the price moved toward our target. I hope you found this video insightful. If you did, please consider liking and subscribing. If you have any questions, feel free to leave them in the comments below. And I'll see you in the next one.